Hello viewers. Today we will be talking about the two most common types of retirement accounts, with those being the Roth IRA and 401k. These two accounts are predicated on compound interest and the appreciation of assets over decades, which is why it's best that the funding of these accounts happen immediately. The idea behind these is that they are supposed to leave you with a decent amount of money in retirement, but hopefully with this information you'll be able to create more than just an income raft for your future self. Websites like Bankrate.com let you know your return on investments, while taking into account all the possible factors of investing. Let's start with a Roth IRA. These accounts can be opened, anytime, through any brokerage or your bank such as Chase, Vanguard, Fidelity and more. These accounts are funded with post-tax earned income. An IRA account allows you to contribute $6,000 a year and $7,000 if you are older than 50. Subsequently to the age of 59 and a half you can withdraw this money, including gains, 100% tax-free. Roth IRAs also have no required minimum distribution, meaning that isn't mandatory that you withdraw these funds at any specific point in time or at all. As lovely as being tax-free may sound, this account still has its detriments. The first is that your Roth IRA contributions are not a tax write-off because you're already contributing post-tax dollars. Also, in 2022, individual tax filers who make over $144,000 a year and married couples who make over $214,000 a year are exempt from contributing to this account. The last not so glamorous attribute about this account is that you can withdraw contributions untaxed, but any profit you'd like to draw back will be subject to a 10% penalty fee and you will have to pay taxes. People prioritizing this generally do so because they believe that in retirement or any distant point in time they will be making way more money than they do that year, so the 0% tax rate is the best way to go. A 401k, on the other hand, is a retirement account that is subsidized by your employer. The self-employed may look into something called a solo 401k with slightly different metrics. These accounts have more rules behind them since they are taxed when you cash out. Anyway, the traditional 401k extends a greater contribution limit of $20,500 in the year of 2022, with pre-tax dollars. You can also use 401k contributions to reduce taxable income and save on taxes. Due to this money being untaxed, you have to fork over your fair share of taxes to the IRS after 59.5. Along with this account is free money that is referred to as an employer's match. There are employers that match 100% of your contribution limit, and there are employers that match significantly lower amounts, and there are also different types of matching, with the most common type being salary-based matching. The three factors behind this match are your salary, your company's match, and their contribution matching limit. Let's put this in perspective. Your salary is $75,000. Your employer's contribution matching limit is 4% and your company match is 50%. What that means is that if you put in 4% of your salary in your 401k, which happens to be $3,000 in this example, your company, which is matching 50%, will end up adding an extra $1,500. This money is completely free and has no hidden fees or penalties behind it. They will, however, try to take it back if you do not stay with them for a certain amount of time. These efforts to try and get their money back are exercised through something called a vesting schedule. I don't have an exact schedule, but it occurs somewhat along the lines of if you stay with a company for less than a year, you do not receive any of the funds they matched in your account. If you stay for 1 year, but not 2, you are 10% vested, and if you stay for 2 years but not 3, you are 20 or 30% vested, which is just a word for the entitlement to your funds. The general idea behind this account is that you feed it in your prime earning years, to then withdraw it later in retirement when tax rates are much lower due to a lower tax bracket and less income. This is what makes the 401k a wildcard, because only God knows what the tax situation will look like 40 to 50 years down the line. Also, you will have to pay standard income taxes and a penalty fee if you wish to withdraw prior to 59.5. All in all, if you don't exceed the income limit for the Roth IRA, it is a safe and astounding option because it's going to grow tax-free, and I feel as if everybody should use one no matter what. As usual, please do in-depth research and analysis and consider any other tax-deferred retirement accounts. Please don't forget to leave a like, comment and sub for more financial literacy content. See you next week at our next wealth gathering.